Mineralys Therapeutics, ticker MLYS, completely missed consensus for the second quarter of 2026. The Q2 GAAP earnings per share came in at negative $2.85, which significantly missed the adjusted consensus estimate of a $2.63 loss. And it absolutely blew past the raw consensus of a 55-cent loss.
Right, and revenue landed exactly as expected at $0, which is, standard for a pre-revenue clinical stage biotech.
Yeah, exactly. Now, looking forward, the company issued cash runway guidance stretching into 2028, and that is backed by $661.4 million in cash equivalents, and investments. But in response to that EPS miss, the stock gapped down in after-hours trading, falling roughly 4.8 to 8.5% down to around $26 a share after closing the regular session at $27.33.
Yeah, the market did not like that number.
No, it didn't. So today we are taking a deep dive into this Mineralys Q2 earnings print. We're unpacking the SEC filings and cross-referencing their recent clinical data to basically answer one critical question for you as a retail investor, like, is posting a $2.85 loss on $0 of revenue a sign of reckless cash burn? Or is there a specific mechanical reason for this massive earnings miss that people might be misunderstanding at first glance?
Well, the initial market reaction tells you exactly how alarming a $2.85 per share loss looks on paper. I mean, for a clinical stage biotech, it sounds disastrous.
Oh, absolutely.
But if you stop your analysis at that headline EPS, you are entirely missing the underlying mechanics of this quarter, because the quarterly net loss widened drastically at $241.1 million.
Right.
To put that in perspective, in Q2 of 2025, their net loss was just $43.3 million.
That is a staggering jump.
It is, but it's not an operational failure. It's not a sudden inability to manage their day-to-day burn. It is a highly specific, one-time strategic capital allocation that just completely distorts the income statement.
Yeah, because I'm looking at the breakdown of those operating expenses, and the concentration is entirely in research and development. I mean, R&D exploded to $221.4 million, up from just $38.3 million a year ago.
Right.
And general and administrative expenses, those tripled to $24.7 million. Now, building out a commercial infrastructure, that explains the G&A bump.
Sure.
But you cannot explain away a near $200 million jump in R&D by simply hiring more lab techs. So where did that capital actually go?
It went directly to Tanabe Pharma in the form of a $200 million upfront cash payment.
Wow. Okay.
Yeah. Mineralys amended its license agreement to buy out and eliminate future royalty obligations for its lead drug candidate, which is lorundrostat. Historically, they would have owed Tanabe a percentage of every single sale if the drug reached the market. So they just bought their way out of that ongoing percentage. The license is now perpetual and royalty-free worldwide.
Hold on. Let's be clear about the terms of that buyout, though, because they aren't entirely off the hook.
No, that's true.
Mineralys still owes up to $255 million in commercial milestones if they hit specific sales targets, plus another $10 million for a potential second indication. So they essentially paid $200 million today to stop paying a high interest rate tomorrow. It's kind of like paying off a massive 30-year mortgage on day one just to avoid decades of high interest.
That's actually a great way to think about it.
Right. It dramatically changes your long-term wealth accumulation, but it completely drains your checking account in the present. So is wiping out these royalties a massive flex of management's confidence in the drug, or just a dangerous depletion of current liquidity right before they actually need money for a commercial launch?
I mean, it is a calculated, aggressive gamble on long-term margin expansion. In the pharmaceutical industry, royalties basically function like a tax on your top line. By eliminating that ongoing percentage, every single dollar of revenue they generate post-approval becomes exponentially more valuable to the bottom line. It fundamentally alters the long-term economics of lorundrostat.
So if it's a hit, it's a huge win.
Exactly. If this drug achieves blockbuster status, like capturing over $1 billion in annual sales, that $200 million upfront payment will look like an absolute masterclass in capital allocation.
Right.
But as you pointed out, it demands immense upfront liquidity. To afford a $200 million buyout while still legally guiding a cash runway into 2028, they had to execute a highly aggressive financing strategy.
Which brings us to the capital stack, because, you don't just find hundreds of millions of dollars in the couch cushions when your top-line revenue is zero.
Definitely not.
They attack this from multiple angles. First, a follow-on public offering of roughly 5.66 million shares at $26.50 per share, which yielded $143.6 million in net proceeds. but equity clearly wasn't enough to foot the bill.
No, they needed more.
Yeah, so simultaneously, they entered into a massive $500 million senior secured term loan facility with Pharmakon advisors, drawing an initial $100 million tranche right away. Plus, they still have $187.2 million available under an at-the-market or ATM equity facility.
And, the structure of that financing is just as important as the dollar amounts. Like,
Yeah.
let's look at the ATM facility.
Okay.
Unlike a traditional block offering where a company dumps millions of shares at once, which usually means you have to offer a steep discount to institutional buyers, an ATM allows the company to quietly drip new shares into the daily trading volume over time.
I see.
Yeah, it gives management this flexible safety net to raise capital incrementally at whatever the prevailing market price is.
I hear the flexibility argument, but I have to push back on what this means for the retail shareholder. Let's look at the actual dilution metrics from that public offering.
Okay, let's look at it.
New investors paid $26.50 a share. But based on the balance sheet, that price substantially exceeds the net tangible book value of the company's hard assets. The company's own filings state that new investors incurred an immediate dilution of $17.64 per share.
Yeah, that's steep.
It is. That means you are paying a massive premium for intangible IP. And furthermore, Pharmakon Advisors is providing senior secured debt. If this drug fails and the company goes bankrupt, Pharmakon gets in line first to liquidate whatever assets remain.
Right. The debt holders always get paid first.
Exactly. Equity holders, like the retail investors listening, are at the absolute bottom of the capital structure. So doesn't building a cash war chest through this heavy equity dilution and debt actually amplify the risk for current shareholders? Doesn't it put a ceiling on the stock's near-term upside?
Well, you are outlining the classic double-edged sword of late-stage biotech financing. Yes, the immediate dilution of $17.64 per share is a bitter pill. You are absolutely paying a premium over hard assets. But, and this is key in biotech, you are never buying the book value. You are buying the discounted future cash flows of the clinical asset.
That's a fair point.
And regarding the debt, your point on seniority is mechanically correct. Pharmakon would get paid first in a liquidation scenario. However, the presence of Pharmakon should also be read as a massive layer of institutional validation.
How so?
Traditional commercial banks do not lend $500 million to pre-revenue biotechs. They just don't. Pharmakon specializes exclusively in life sciences. For them to commit $500 million, their internal underwriting teams had to rigorously audit the clinical data and the commercial viability of lorundrostat.
Okay, so they did their homework.
Exactly. They aren't in the business of lending to companies they expect to liquidate.
All right, let's test that validation then. Because all of this financial engineering, the debt, the dilution, the massive royalty buyout, it is all pointed like a laser at one specific date, December 22nd, 2026.
The PDUFA date.
Yes, the Prescription Drug User Fee Act target date. This is the exact day the FDA is scheduled to hand down its approval decision for lorundrostat. Now, this drug is an oral aldosterone synthase inhibitor aimed at treating uncontrolled and resistant hypertension. We need to explain the mechanics of this because this is the entire foundation of their evaluation. Why is targeting aldosterone the key to treating resistant hypertension?
To understand why this matters, you have to understand the biological mechanism of blood pressure. The body regulates blood pressure through a complex hormone cascade called the renin-angiotensin-aldosterone system.
Okay.
Aldosterone is a hormone produced by your adrenal glands. Its primary job is to tell your kidneys to retain sodium and water and to excrete potassium.
Got it.
When you retain more sodium and water, your blood volume increases. Think of it like pumping more water through the exact same size pipe. The pressure against the walls has to go up.
So for a normal person, that system is what keeps you from passing out when you stand up quickly? But for these patients, the system is fundamentally broken?
Precisely. In many patients with uncontrolled or resistant hypertension, they have dysregulated aldosterone production. Their bodies are essentially stuck in a loop, overproducing this hormone. They are retaining too much fluid, and the pressure in the pipes is critically high.
Right.
Now, standard blood pressure medications like ACE inhibitors or ARBs, they try to block different parts of this hormone cascade, but they don't stop the actual production of aldosterone at the source.
But that is what lorundrostat does.
Yes, it is an inhibitor that physically blocks the specific enzyme responsible for synthesizing aldosterone in the adrenal gland.
Which brings us to the clinical data from the Transform-HTN and Launch-HTN trials. If standard therapies are failing these patients, what did these trials actually prove about lorundrostat's efficacy? I mean, does the data justify this binary risk?
It really does. The data demonstrated robust, durable, and clinically meaningful reductions in systolic blood pressure. We are talking about trial cohorts of patients who are already taking 3, 4, or even 5 different blood pressure medications, and their blood pressure is still dangerously high.
Wow, 5 medications and it's still high.
Right. And when lorundrostat was added to their regimen, it successfully lowered their blood pressure to target levels while maintaining a highly favorable safety profile. The mechanism works.
Mhm.
By shutting down the factory that makes aldosterone, the body finally releases the excess sodium and water, and the pressure drops.
And management is clearly signaling that they view this FDA approval for hypertension as just the opening act. On the earnings call, they heavily emphasized evaluating the drug for chronic kidney disease, or CKD, and heart failure.
Yeah, there's a huge market.
They cited a post hoc analysis from their pivotal trials showing a 52% placebo-adjusted reduction in a key urine biomarker for CKD. For an investor trying to value this long-term pipeline, what does a reduction in a urine biomarker actually tell us about kidney health?
Well, it is a critical leading indicator of organ recovery. The biomarker they're tracking is typically the urine albumin to creatinine ratio, or UACR.
Okay, what does that mean in plain English?
Right, so albumin is a protein found in your blood. Healthy kidneys act as a microscopic filtration system. They keep the albumin in the blood and filter out the waste into the urine.
Right.
But when the kidneys are damaged, which is often due to years of high blood pressure just pounding against those delicate filters, the filters tear, and albumin starts leaking into the urine.
So a high level of protein in the urine means the filter is broken.
Correct. So when Mineralys reports a 52% reduction in this biomarker compared to a placebo, it means the drug is significantly reducing the amount of protein leaking through the kidneys.
That's massive.
It is. It suggests that by lowering the systemic blood pressure and modulating aldosterone, lorundrostat isn't just masking a symptom. It's actively relieving the physical stress on the kidneys and allowing those microscopic filters to begin healing. If they can secure an expanded label for chronic kidney disease down the line, the total addressable market for this drug expands exponentially.
That paints a very rosy picture of the science. But we have to transition to the commercial reality, because having great science in a trial setting does not automatically translate to commercial dominance.
No, it definitely doesn't.
During this same earnings print, management announced a major executive shuffle. They appointed Dr. Terry Ferguson as the new chief medical officer, succeeding Dr. David Rodman, who is transitioning to a strategic advisor role.
Yeah, that caught some people off guard.
I have to question the timing here. Swapping out your chief medical officer just months before the FDA decision date, is that a potential red flag signaling internal panic, or is it simply a necessary transition?
It's the latter. It is a highly strategic, planned pivot from a clinical research leader to a commercial launch leader. This is actually a very standard transition playbook in the life sciences sector.
Really? Just swap them out?
Yeah, if you look at their respective resumes, it makes perfect sense. Dr. Rodman is a brilliant clinical researcher. He did the grueling work of designing the pivotal trials, proving the concept, and filing the new drug application with the FDA. His job was to get the drug over the regulatory finish line.
But getting FDA approval and actually selling the drug are two completely different skill sets.
Exactly the point. Dr. Ferguson is a 35-year cardiovascular veteran. He has deep commercial stage experience at heavyweights like Amgen and AstraZeneca. The company doesn't need a trial designer anymore.
Right.
They need a chief medical officer who knows how to design post-marketing studies, how to present data at massive cardiology conferences, and how to convince prescribing physicians to actually adopt a new therapy. Ferguson brings that big pharma commercial pedigree that Mineralys desperately needs for launch.
Okay, let's talk about the obstacles that commercial team is going to face, because the risks bearish analysts are warning retail investors about are pretty severe.
They are.
First is the binary nature of a single asset company. Mineralys' entire valuation hinges on the successful FDA approval and commercial launch of lorundrostat.
Yeah, all their eggs are in one basket.
Exactly. If the FDA issues a complete response letter, which is a rejection, or if there's an unexpected manufacturing delay, or even if they approve it but slap a negative, highly restrictive label on it, the result is severe capital impairment. Holding MLYS stock into December is basically like a high-stakes spin on a roulette wheel.
It really is. The single asset risk is the defining feature of the stock right now. But even assuming a flawless FDA approval in December, the commercial and competitive pressures are brutal.
Yeah, the market is crowded.
They are entering a cardiovascular space dominated by established pharmaceutical giants with massive entrenched sales forces. AstraZeneca, for instance, is actively developing its own rival drug called baxdrostat.
So they won't even be alone in this specific niche.
No, Mineralys is not going to have a monopoly on this mechanism of action. They're going to have to fight hand-to-hand for market share against companies with infinitely deeper pockets.
And even if they beat AstraZeneca on efficacy, they still have to convince the insurance companies to actually pay for it.
Which is incredibly difficult.
Right. Management openly admitted that securing broad payer coverage, especially Medicare, is going to create severe friction for the revenue ramp. They expect Medicare coverage to move significantly slower than commercial coverage. Why is Medicare such a critical threat to them?
Because of the target demographic. When you are treating resistant hypertension and chronic kidney disease, a massive percentage of your total addressable market is over the age of 65.
Right, so they're mostly on Medicare Part D.
Exactly. And the statutory process for getting a new drug reviewed, priced, and placed onto Medicare formularies is notoriously bureaucratic and slow.
So even with a December approval, doctors might write the prescription in January, but the patient goes to the pharmacy and Medicare just refuses to cover it.
Precisely. If it takes an extra 12 to 18 months to secure broad Medicare coverage, revenue generation just stalls. But during that 18-month waiting period, Mineralys still has to pay the salaries of their newly hired national sales force.
Right, they still have overhead.
They still have to pay for marketing. That $661 million cash runway, which looks so comfortable today, will start burning at an accelerated rate with very little cash coming in to offset it.
Wow. Given the steep pre-commercial cash burn, the threat of AstraZeneca, and this Medicare delay, does the clinical data actually justify taking on this level of binary risk for a retail investor's portfolio?
That is the ultimate question of risk tolerance for anyone looking at this stock. The clinical data absolutely supports the mechanism. For patients suffering from resistant hypertension, lorundrostat represents a legitimate physiological breakthrough.
It fixes a broken system.
Exactly. It fixes a broken system that older drugs simply cannot address. If Mineralys can survive the commercial ramp-up and achieve broad formulary coverage, the revenue potential is staggering. And because they spent that $200 million to wipe out the royalties, they get to keep a vastly larger share of that revenue.
Right, the margins will be incredible.
But you are entirely correct about the execution risk. The science is largely de-risked. The business model is not. You can engineer the best molecule in the world, but if cardiologists default to AstraZeneca's competing drug, or if Medicare refuses to reimburse it, the stock will suffer regardless of the clinical data.
Which perfectly frames why they adopted this chips-all-in financial strategy. They know the commercial ramp is going to be brutal, so they're aggressively fortifying the balance sheet today, accepting the dilution, just to ensure they have the stamina to survive the Medicare waiting game.
Yep, it's a marathon, not a sprint.
If you are navigating the biotech sector or just trying to make sense of these complex financial structures, make sure to follow the show. We provide daily, tight, and concise earnings coverage so you never miss the underlying mechanics driving your portfolio.
Because, as we saw today, a massive earnings miss on the headline can sometimes mask a really brilliant long-term strategy.
Absolutely. We will leave you with this final provocative thought to mull over as we approach that critical December 22nd FDA date. If lorundrostat successfully secures FDA approval this winter, will Mineralys' aggressive $200 million royalty buyout be remembered as the smartest margin-expanding move of 2026? Or will it just be a footnote before a larger pharmaceutical giant acquires the newly de-risked company outright for its cardiorenal metabolic pipeline? Think about it. We'll see you next time.